Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Dropbox's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Dropbox mainly stores files online and allows users to sync the files between their personal devices and on the cloud. Some people use it for personal reasons, and companies of all sizes also use the service. You can use Dropbox for free or pay $9.99 or $19.99 per month and receive additional services. The company is headquartered in San Francisco, California, and was founded in 2007. It trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, Xetra, Vienna, Swiss, Moscow, and London Stock Exchange. Let's get started with the model. This is a mid-cap company, 9.2 billion market cap. They're trading at $24 a share, and they have 382 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have positive and growing free cash flow each year. It's over $700 million in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative every year. Revenue is the sales for the company, and that's been growing nicely each year from 1.4 billion up to 2.1 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that peaked in the trailing 12 months. Below that is their operating expenses and then their operating income, which was positive for the first time in 2020, and it more than doubled from 2020 to the trailing 12 months. And the bottom line of the income statement is their net income, which is negative every year. The reason it's negative in 2020 and the trailing 12 months are these large write-offs. So I would just focus on operating income when I look at the income statement, not net income. This is their latest income statement from their most recent 10Q, first 9 months of 2020 versus the first 9 months of 2021. And the top line is the revenue, the sales. That grew from 1.4 billion to 1.6 billion. A little more than half their revenue is in the US. The rest is outside the US. That's a big benefit to have access to sell to people all around the world. And they can easily do it because it's a tech company. If they sold physical products, they still could sell all over the world. It's just a little more difficult. It's just as easy to provide their service to people outside the United States or inside the United States. And their revenue is generated by individuals, families, corporations of all sizes. And they do that by selling monthly or annual subscriptions to their service. Below revenue is the cost of revenue. Payroll cost is a big cost of revenue, plus technology fees. Their gross profit went from 1.1 billion to 1.3 billion. Research and development costs were about $500 million. Sales and marketing were 300 million. G&A expenses are the day-to-day costs to run the business. Payroll for support functions and rent are examples. They passed through 17 million of real estate impairments. Their operating income tripled from 2020 to 2021. So their revenue went up, but their margins went up even more. They do have 2.5 billion of debt on their balance sheet, but they receive so much interest income from their investments, it almost covers their debt payments. Last year, they received 2.6 million of interest income. So the interest they received on their investments more than covered the interest they paid on their debt. And their net income looks really good, growing from 90 million to 211 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you could think of operating cash flow as net income converted to cash. When we looked at the income statement earlier for 2018, 19, and 20 and the trailing 12 months, they had a net loss every year. But they're generating positive cash flow. That's because of all the non-cash items they're passing through onto their income statement. They don't spend too much money in CapEx. The most they spent was 138 million. Operating cash flow minus CapEx gives you your free cash flow. And they have positive free cash flow every year. Positive free cash flows are the funds that are remaining to benefit you, the investor. So the company could pay a dividend. They don't yet. They could buy back stock. They do a lot of that. They bought back $350 million in 2018, $85 million, $400 million, and $1 billion. When a company buys back common stock, it decreases the shares outstanding and makes your shares more valuable. It gives you a bigger piece of the pie. They did add some stock in 2018, $770 million. But overall, they're buying back more stock than they're adding. But another way to benefit you, the investor, is to pay down debt. Because when a company pays down debt, there's less interest they have to pay on that debt, which means more money flows to the bottom line. You can see their CapEx is pretty small, and CapEx is part of investing cash flow. So their CapEx was only $33 million in the trailing 12 months, and they had a cash outflow of $600 million in investing cash flow. That may have been to acquire another business. That's another thing the company can do with free cash flow, is to acquire other businesses, because that can benefit you, the investor, because if the company grows its revenue and brings in more profits, then there's more money to give you as a dividend or to buy back stock. This is their cash flow from operations section from their most recent 10Q, the first 9 months of 2020 versus the first 9 months of 2021. And the way you calculate CFO, you start with net income, then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. So we have to add back the $110 million of depreciation, that's a non-cash item. In addition to paying an employee a salary, another way to reward them is to give them stock. So they gave out $215 million of stock in the first 9 months of 2021. But this is a non-cash item. When Dropbox issues stock to its employees, there's no cash outlay, although it does dilute the current shareholders. We have to add back that $17 million impairment. There's $2.8 million of amortization of debt issuance costs, $23 million of amortization of deferred commissions. To give you an example of this, say Google contacted Dropbox and said, we want to use your services for 50,000 employees. So obviously Google wants a good deal because they're giving them a lot of business. So Dropbox says, if you pay $10 million up front, you can have the entire year for all 50,000 employees. Even though Dropbox received $10 million up front, they don't want to put the entire $10 million on the income statement. Then during that quarter, it looks like their income is so inflated. And then in future quarters, it's going to look a lot worse. So they just want to spread that revenue over the 12 months of the contract with Google. So they put it onto their balance sheet, and every month they take 1/12 of the $10 million and pass it onto the income statement. But it's a non-cash item because the cash all happened in the first month. The purpose of the statement of cash flows is to track cash. And they booked that $10 million when they first received it from Google. But the income statement uses accrual accounting. It's supposed to smooth out revenue and expenses. And then there's changes in working capital. Even though they reported a net gain of $211 million, they actually generated $567 million of cash flow. If cash flow from operations is worse than net income, that's something you want to look into. That may indicate a problem. But that's not the case with this company. This is their cash flow from investing and cash flow from financing section. The first 9 months of 2020, the first 9 months of 2021. And cash flow from investing starts with CapEx. That was $21 million. It looks like they spent $125 million to merge with another business. Most companies don't like to keep cash in the bank because you earn pretty much no interest. So they buy short-term investments. They spent $1 billion on short-term investments. It's still a pretty low interest rate, probably 1 or 2%. It's just to get a little interest on it, but keep it liquid enough so they have access to it. And they sold $270 million of short-term investments. That was a cash inflow. $350 million of short-term investments matured. So maybe they needed $600 million. $350 million matured. And then they had to sell another $270 million to get that $600 million. So in their investing section, they had a cash outflow of $560 million. In their financing section, they received $1.4 billion from issuing convertible notes. They bought back $265 million of convertible debt from their investors. They received $200 million from the sale of warrants. Warrants are long-dated options. When they pay employees with stock, they still have to pay taxes on that. That was $98 million of taxes. And they bought back $763 million of common stock. So they had a cash inflow of $369 million in the financing section. Last year, they had a cash outflow of $308 million. According to their 9/30 balance sheet, they have negative $163 million of equity. They raised $2.5 billion from selling their business, and they lost $2.6 billion from running their business. Accumulated deficit is a sum of all their prior net incomes. So they had negative net income almost every single quarter. Until this year, they had positive net income every quarter in 2021. If they continue growing their net income, they'll turn this accumulated deficit to a profit in maybe 2 or 3 years. Let's look at the capital structure. They have negative 163 million of equity. That means their liabilities are 163 million more than their assets. And they have 2.5 billion of debt. So they're 0% equity, 100% debt. And I gave them the highest whack on Finbox, 8%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 16 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $13 billion. We divide that by 382 million shares. And we get a calculated stock price of $35. They're trading at $24, so they're trading at a 32% discount. It's a buy according to the model. The average analyst projects their revenue to grow 10%. So to calculate their future revenue estimates, I grew at 10% for the next 4 years. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, I divided by these 4 revenue numbers. And that comes out to 27.5%. So I multiplied their future revenue estimates by 27.5%. That's how I got their future free cash flows. Simply Wall Street is way higher than me. They're at $53 a share. They're saying it's 55% undervalued. 3 analysts priced this stock and the average price target was $32. The low was $25, the high was $39. This is where the stock has been trading the last 2 years. It was over $40 a share 2 years ago at one point. It looks like it bottomed out around $15. And then recently it came up to about $32, $33. But the market hasn't been doing that well recently and has come down a lot the past few months. So it looks like it could be a good buying opportunity. Their beta is 0.91, so the stock moves pretty close to the market. It's gone up 17% in the past 52 weeks, while the S&P is up 23%. The 52-week low was 20, the high is 33, and the stock is trading below its 50-day and 200-day moving average. In the past 10 days, over 4.5 million shares have been traded on average each day. 82% of the shares are held by institutions, and over 6% of the shares on float are shorted. Their employee count is up about 30% since 2018. It's been flat the past year. If you put $10,000 into this company when it IPO'd, within the first year you would have been up a bit, but after that you would have been really unhappy because your $10,000 would have been cut in half. But just a few months ago, that $10,000 investment would have been a little more than $10,000. Since the stock has been declining the past few months, you'd be at about $8,000 today. That's a 20% loss. Last month, the founder and CEO of the company sold 1 million shares. In the beginning of the year, an insider bought 100,000 shares. That's the only insider activity. The general public owns about 9% of the stock. Insiders own about 1/4, and institutions own about 2/3. The biggest shareholder is the CEO at 24%. His stock is worth $2.2 billion. The next is Vanguard, BlackRock, Pictet Management, and Columbia Management. Let's look at their financial ratios. We can't look at the PE since they have negative net income. We can't look at the price to book since they have negative equity. The good thing about the price to sales ratio is we can always look at that, unless they have no sales. But as long as they have some sales, then we can look at the price to sales ratio. It can never be negative. And it is pretty good that price to sales of 4.4. It's between the market median and average. But it's best to look at ratios against companies in their industry, which we're going to do in a little bit. They have an amazing return on invested capital of 53%. They can cover their interest payments 4.5 times with their operating income. We can't look at their ROE since they have negative equity. And they have a good current ratio and quick ratio of 1.7. They have 1.9 billion of cash or short-term investments on their balance sheet. So they do seem to be well capitalized. They do bring in positive free cash flow of 700 million. They have nearly 900 million of working capital. Working capital is current assets minus current liabilities. So they have $1.6 billion of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 19 companies in the same industry as DBX. We can't look at their PE. They do have a really good price of sales relative to the industry average. Their current ratio is fine. We can't look at their ROE. They're 100% debt. And there's some really huge companies in this industry, so they're a lot smaller than the average. So to summarize, I have them trading at a 32% discount. Companies in this industry, tech companies, tend to be high growth. And there is a ton of competition because there's some major tech players in the game. But they do have a specialized niche. They just focus on their core service. The larger tech companies like Microsoft or Apple focus on so many different products. And they seem to have great brand awareness, so I think there's a lot of room for growth on this stock. I rank their free cash flows 8 out of 10, their revenue 7 out of 10, and their ratio is 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.